Hello, our dear learners. Most grateful to have you. Most grateful to have you for our sessions, in particular to benefit from our learning media. We're also pleased for those of you who are attending the e-learning classes. We are the same tutors. So try to test both the videos and the online classes. The session of the moment is in regards to financial statements of companies. Here, company financial statements. This follows one having learned, especially sole traders, partnerships. It's much easier. You learn in that sequence, sole trader partnerships, before you learn about company accounts. Now, company accounts form one of the most common, if not the most common, questions in the examinations for CPA Part 1. I mean, CPA Foundation, which used to be CPA Part 1 for that matter. That this will always, it has been and it will always be a very popular question because it's very different from all the other topics. So the first thing I would want us to learn is some special items or terms. Some special items, they also have special terms which go with these items that form the financial structure or are part of the financial structure of a company. What I mean by financial structure is when we prepare the financial statements, there are certain terms that are unique. There are certain terms that are unique to a company. And these are some of the terms that we are going to have a look at. First then, let's understand what is a company. We say it's a corporate entity formed by registration under the provisions, that's under the rules and requirements of the Companies Act in the Kenyan case. Now, how does a company differ? How does a company specifically differ from, say, partnership or sole trader? Now, one thing is that a company is constituted by 2 or more persons. Yeah, there's a minimum membership of 2 persons. The other thing is that the capital of the company is divided into units, and those units are called shares. When you add up those units, it becomes, the total is called share capital. So 2 very important things about a company, those ones. The other bit of it is the relationship between the company and the owners of the company. That the company and the owners are treated as separate entities at law. The company is one entity. The owners of the company are each one of them an entity in their own right. They're called shareholders. So that makes the company very different from partnership. Because like, okay, sole trader and partnership. In sole trader, the owner and the business are one and the same at law. Partnership, one and the same at law. But when it comes to companies, the owners and the company, their legal rights and obligations, belongings, possessions are completely distinct. Okay, when we're preparing financial statements of a company, there are some very significant terms here. We have share capital, reserves, debt capital, dividends, and taxation. What I want to do next then is, if you're looking at a question, if you're looking at a question, you also be looking out for these various terms here. I first then want to explain. This is share capital. Yeah, what that means is that equity capital which is divided into equal units called shares. Yes, when shareholders invest money in the company, That amount is divided into units, and those units are called shares. So we talk of share capital, we talk of shares. Now this share capital, we have got different types of share. We have ordinary shares. Yes. Now these are shares which the holder of such shares claims to be an owner of the company, because they can make decisions at general meetings of the company. They can order the directors of the management of the company to do certain things. So the holders of the ordinary shares are the true owners of the company. They are called equity shares, because when you hold these shares, you have the right to influence decisions of the company. I don't mean right to manage, right to make decisions on behalf of the company or for the company. So we have ordinary shares. These are equity shares. We have preference shares. And these preference shares, we divide them into what we call redeemable. We have redeemable preference shares. The word redeemable means the money can be returned to the shareholders. So if you buy shares in the company, preference shares which are redeemable, it means the shares will be held for a certain duration and the money will be returned. It will be returned to the you as the shareholder. So these redeemable preference shares are treated as a form of loan. They are a form of loan, though they are called shares. Then we have what we call irredeemable preference shares. Irredeemable means once you have invested money in the company, it becomes like the ordinary shares. The amount is not paid back. Yes, you can sell the shares between yourselves as shareholders, but you cannot, you cannot sell back. You cannot, in other words, the company cannot buy back the shares, cannot give you back the money. Irredeemable preference shares, these ones are a form of equity. A form of equity. Yes, that's how we shall deal with the share capital. The next is reserves, the essence of reserves. The essence of reserves. What reserves are profits This is profits or other gains that is surpluses which are retained by the company. The company that is undistributed. If the company makes profit and has not distributed the profit, we use the term reserves. Okay, reserves are not, do not make a mistake between reserves and savings. Savings is the money you have in the bank. Reserves, these are on paper. We have made this profit. We have distributed this profit in the form of dividends, and this amount of profit which is remaining. So what happens then is the share capital, the equity share capital now equity share capital is ordinary shares and irredeemable preference shares. If you add this to reserves, you take equity share capital and add reserves, what you get here is shareholders' equity. Shareholders' equity. Yes, I didn't want us to just plunge into the question before we understand before we understand shareholders' equity. So this equals shareholders' equity, that is the portion of the capital which is owned or which is controlled by the owners of the company. The owners of the company can only have control over their own portion of resources, but not the amounts which are borrowed. Then the next thing is about debt capital. The debt capital. So here I'm talking about long-term borrowings. Long-term borrowings of the company. That is money that the company will have to pay after a considerable period of time. Now here we have, for example, this is long-term loans. Then we also have what we call debentures. Now, in both cases, the company has borrowed money, but the manner in which it will be repaid is what differs. These loans can be paid back by installments, but these debentures, the amount will be paid back at once. That is, you have a certain duration, a term. For example, you have agreed to take a loan on a 10-year term. These debentures are a loan which is divided into units. It's divided into units like shares, but they're not shares. They are a form of debt or a form of loan. What's the difference? With share capital and reserves belong to owners, or rather claimed by the owners. The debt capital by outsiders or people called lenders. Now, next is the dividends. The next term is dividends. The item dividends. So what we mean by a dividend is a distribution of profits to shareholders. When the company pays a portion of the profit to shareholders, we call these dividends. Now we have two types of dividend. We have ordinary dividend. When the dividends are paid to ordinary shareholders, we talk of ordinary dividend. Then we have preference dividend. I'm trying to simplify the topic. Preference dividend, ordinary dividend. Preference dividend is the dividend that the company will pay on preference shares. Ordinary dividend, what is payable on ordinary shares. So preference dividend is for preference shares. Ordinary dividend is for ordinary shares. Now, what happens at the end, in the course of the period, the company may pay dividends, the payment of dividends may be done in installments. There is interim dividend and proposed dividend. So when it comes to payment, of dividends, it's done this way. There is interim dividend. Interim dividend. That means the dividend was paid in the course of the year. And then there is proposed dividend. This is a suggestion. The company has made a resolution in general meeting that the shareholders will be paid another dividend above the interim dividend. The interim dividend is the one which has already been paid. This is the one that is coming next, and it may be ordinary or a preference dividend. Last important term here is taxation. Now this term, taxation, is referring to, this is corporation. Corporation tax. which is based on profit, which is based on profit, on the company's profit, on the company's profit. So after we have calculated the profit, we say profit before tax minus taxation equals profit after tax. So that is, these are the important items. These are some of the important items. Now, as concerns reserves, I may need to make some small clarification here about reserves. These reserves are profits or any surplus, any gains the company has made but has not shared out or has not made use of. You know, when you make any work, you do some work and make any benefits or gains, you spend it. You have expenditure, you use it. Now, that portion of the profit or gains the company has not made use of is classified under reserves. And these reserves come in different ways. We have a reserve called share premium. This one comes from the company selling shares or issuing shares to shareholders. As the company issues shares to shareholders, it makes sometimes a profit by selling the shares at more than what we call the nominal value. Then that extra price is called the share premium. Then we have retained earnings or revenue reserve. It's called retained earnings or revenue reserve. This is now from the normal profit the business makes. You know, the business is trading. From the trading, after paying expenses, how much profit does it make? Where does the profit go? Some of the profit is going to be retained as retained earnings. This profit is the profit that is at the disposal of the management. If they want to pay dividends, they pay from the retained earnings. Then we have got general reserve or reserves. These are reserves which can be used for a variety of purposes. Such a reserve is built from here. After getting these retained earnings or retaining some earnings, we may decide that it's too much retained there. We transfer some of it to general reserve. Once it's in this plate, this platform, it can be used for a variety of purposes. But once in the form of retained earnings, it's usually for the purpose of, you can either use it for paying dividends or you can use it for issuing what you shall be able to call bonus shares. So generally then, these are the key terms. The next thing is how do we present or prepare the financial statements. So that is next. Yes, so we have the next thing is how do we present financial statements of a company? This is the question, and I'll in the normal way just go through it very quickly, explaining certain expressions and certain items. Yes, explaining certain items. One, here we have the following balance were extracted. The following balance were extracted from the books of Upendo Limited for the year ended 31st December 2013. So the company presents itself in form of, you know, in economic terms, this is who we are financially. Now you can be able to see a number of the items I mentioned about the financial structure. This is then what happened. We have ordinary shares. Now this information is the information that would have been found on a trial balance, but it has been prepared in form of a list. Now you can guess why the examiner would want to give you something in this shape. The reason is not to help you too much in solving the question. So here we have ordinary shares. I mentioned there are different types of shares or share capital. We have ordinary share capital, we have preference share capital. So we have ordinary shares, we have preference shares. Then we have inventory. The inventory has been mentioned clearly to be at 31st December 2013. Trade receivables, the bank balance, 10% debentures. Yeah, the debentures are a long-term loan. General reserves, I've mentioned general reserves, gross profit for the year, bad debts expense, that is salaries expense, insurance expense, telephone expenses, we have electricity expenses, we have debenture interest, we have directors' fees, we have general expenses, motor vehicles at cost. Accumulated depreciation stands for the depreciation of the previous or the past years. Then we have office equipment at cost. Okay. Accumulated depreciation, as usual, that stands for the depreciation of the previous or the past years. Then we have office equipment at cost. Okay, repeated. Land, billings. We shall remember to combine land with the billings. We have trade payables. Yes, we have the amount for trade payables. What else do we have? Revenue reserves. There it is. Additional information, accrued expenses, electricity expenses amounted to 548. Number 2, the amount for insurance includes a premium of 300,000 paid in September 2013 that will cover the company for 6 months from 1st October 2013 to 31st March 2014. Okay. 3, depreciation is to be provided for as follows. Office equipment, 15% on cost. Motor vehicles, 20% on cost. Yes, that means we are using, the company is using what method? The company is using the straight line method. When you calculate depreciation on cost, we are using the straight line method. Then provisions are made for the following: directors' fees, audit, and outstanding debenture interest. First of all, the term provisions. We have the term liabilities and we have the term provisions. Very close together that they can easily be confusing. When you talk about liability, we are talking about an existing debt or obligation that comes from or results from our past activities, which requires payment of a certain sum of money in the future or some other settlement in future. But when it comes to a provision, it is also a liability that has resulted from our past activities, but whose exact figure is uncertain, is still undergoing estimation or ascertainment. So in the case of the liability, the amount is a certain sum. But in the case of a provision, it's an estimated amount. But both of them are going to, when we are going to present the financial statements, we shall present them as liabilities. Next, the directors have recommended the following: 12 million to be transferred to general reserves. That out of the retained earnings or out of the revenue reserves, we shall transfer 12 million to general reserve. Sometimes we crisscross like that. We transfer money from, amounts from one reserve to another. Dividends on preference shares to be paid. The preference shareholders are people who have given the money in the name of shareholders, but they are actually lenders legally. Because if they are not paid their dividend, they can easily sue the company and enforce the payment. But ordinary shareholders cannot enforce payment of dividends. No, they can't. They are the true owners of the company, or the equity owners of the company. They are the risk takers. And if the company declares dividend and again fails to pay them, there's nothing they can do. Legally, they cannot enforce. Then payment of a 10%, okay, dividend on ordinary shares. Next, we are required to do income statement and statement of financial position. So now the question is, how do we start such a question? That is what is next, how we solve the question. Okay, the first step, of course, is the workings. So we start with the example. This is Upendo Limited. All right. Yes, that's okay. So the first thing is we are given electricity there. How do you do your workings? You make your workings as short as possible and you number your workings. You say, this is working number 1, electricity. And make sure your writing is clear. Don't imagine every examiner you write like a bad handwriting. We're told here for as far as electricity is concerned, the amount paid is 1216. We have 1216, and we have for electricity an accrual. So this is what you're saying, electricity expense, we say is 1216 plus 548. And the sum total is what you show there next. The sum total of that, 1764. I'm not trying to show you how to do arithmetic, but I'm trying to show you how to do it quickest for the examination sake, because there are 2 factors in the exam, the accuracy and the time. So we have to try very much and balance. So I'm trying to avoid getting word here. Once I use the word expense on top here, the examiner will have no excuse for not marking this correct. Okay. The other amount is insurance, or is it insurance and what? Insurance and rates. Working number 2. Insurance and rates. The amount stated is 1410. The expense is 1410. The prepayment for insurance and rates is 150. Okay, this is the way I get the 150. I divide this amount by 2. The amount which is given, amount for insurance includes a premium of 300,000 paid in September 2013 to cover the company for 6 months up to 1st of October 2013 to 31st, from 1st of October 2013 to 31st March 2014. So a half of that amount is a prepayment. So what we do is we deduct the prepayment of 150 from 1410. 1410 less 150. That is 1260. That's the amount, the charge for insurance. The next thing we'll look at is depreciation. So in my working number 3, I'll go to, there are 3 assets. This is property, plant, and equipment, and the depreciation. There are 2 items which are depreciating: motor vehicles, and office equipment. I'm only concerned with those which are depreciating. I start with the cost. Trying to be very careful with the space. At cost, the amount for the motor vehicles was 29,100. Office equipment the amount was 44,640. That's the cost. Then there is the accumulated depreciation brought forward. That is, how much was the depreciation from the previous? We have accumulated depreciation for motor vehicles was 22,300. This is from the previous what? This from the previous year. 22,300. 22,300, then 17,200. What I'm doing, I'm deducting the depreciation that occurred in the previous year. Then the depreciation charge or expense, this will be 15%, and there are two assets. One depreciates 15%, the other one is 20%. You are free to do this. Examiners will appreciate that. They are sharp, they can understand what you're doing, but they cannot understand what you have not done. They'll understand what you've done. This is it. So what you mean is 15% of 29,100. 29,100 times 0.15. Yes. So the depreciation for the first asset, that is for the motor vehicle. The motor vehicle, motor vehicle 20%, that is 29,100. That is 58,20 for motor vehicles, 58,20. What is the use of this amount? This amount you're going to show as an expense. This is the amount that you're going to show as an expense. Now the other asset, this is 44,640. That's office equipment times 0.15. The cost of the office equipment is 44,640. And you have to depreciate office equipment at 15%. That gives us 6696. 6696. What is this? The depreciation for the current year. What I've got is the depreciation amounts for the current year. What I'm looking for is the net book value or the written down value at the end of the period. The net book values at the end of the period, these are the figures I'll require when I'm preparing the statement of financial position. So 29,100 less 22,300 less 58,20 is 980. That means 980,000, the remaining value of the asset. 4,640. We have 20,744. Yeah, so we have those written down values. For the other assets, the information is given in a very straightforward way. Now we have these other provisions. Yes, we have these other provisions. So working for directors' fees, audit fees, debenture interest. Yes, so this is directors' fees. These are the rewards given by the company to its own directors for running the company and also running it well. Give them also commissions. So the amount of the directors' fees total, expense, that is the total expense that you'll show in the profit or loss for director's fees. Previously, there was director's fees of 2,500. This is what was paid initially. They had paid director's fees of 2,500. Now they have passed or approved, or they are providing for, not approved, but providing for another possible 5. I told you a provision, okay, not possible, but probable. It's probable that the company will pay another 5 million. So the total amount probable expense is 7.5 for director's fees. Now, audit fees. Audit fees is being provided for. Well, it means there is an audit in progress. As it's usual, at the end of the year, the auditors come around. They conduct an audit of our books and financial statements. So as the audit is going on, the auditors will keep determining the bill. They don't determine it at once in advance. They will keep determining the bill depending on how much work they find. So we are not very sure at the end of the period. That's why we're using the word provision. We are not very sure how much the auditors will charge until they have actually charged. So what we're doing here is estimating. Now the estimated bill, this is the estimated bill for the auditors of 1.2 million. The amount cannot be confirmed with accuracy until, the amount cannot be confirmed with accuracy until the thing is complete, until the audit is complete. Now it's far from complete. How do we deal with such? We debit an expense account called audit fees or audit expense account. We credit an audit fee liability account or accrued audit fee account. So two things: we debit the expense, we credit the audit fee account. Then the next one is about debenture interest. Yes, debenture interest. Let's work in 5. As I said earlier in the introduction, the term debenture relates to a long-term liability, which has been divided into units called shares. Now, at the end of each year, of course, we have to pay or provide for that interest. Now, the total interest yes, there we are about the debenture interest. The amount, the total interest, the total amount of interest would be 10%. 10% of what? 10% of 16,000. That is 1,600. Then we have the amount which is paid, interest which has been paid, according to the schedule of balances and items given there. The debenture interest paid is 800. So when we are given such, what we do is we deduct what has been paid to give us what is accrued. Yes, so that is the amount of interest accrued. And it will be a current liability. The amount which will be the expense is this one. The amount which will be a liability is this one. That's how we go about it. Next expenditure, we consider there is a preference dividend somewhere. When we go to note number 5, the directors have recommended the following: 12 million to be transferred to general reserves. So what you are going to get in number 6, general reserve, this is a reserve, I said, for general purposes, and you build this reserve from profits. But first of all, the profits made are entered in the revenue reserve. Then from the revenue reserve, it's poured over to the general reserve. So the amount of general reserves given the question was 28 million. 28 million. Now we are adding, we are transferring. You know, some mathematics are so simple. You don't need to keep writing a lot of words here. They're saying 12 million is coming from the revenue reserve, and it will be added here. So 40 million. The 40 million is what is going to be added here. After adding the 12 million is what we're going to show us the general reserve. We've done director's fees. We had the preference dividend, working number 7. Preference dividend. Now, one thing about preference shares is that they carry a fixed rate of dividend. They carry the right. The shareholder has a right to a fixed rate of dividend and amount every year. Whether the company has made profit or not, the company will have to pay a preference dividend. Now, the preference dividend here, which is proposed, is 10%. The preference dividend is, 8%. Dividend on preference shares shall be paid. They don't say what percentage because the percentage is fixed. 8% of 40,000. That is 3,200. That's how we write it. That is the preference dividend, which is fixed and payable every year, regardless of the situation. Now, the next we've done about general reserves, just confirming that everything is done. Yes, yes, yes. The only thing that remains that you do later, before we prepare the statement of financial position, is the revenue reserve or the retained earnings. So now, once we've done that, the next step is to try and prepare the financial statements. Yes, that is the next step, preparing the financial statements. Okay, so the next step is how do we present this in the form of financial statements? The question starts us with the gross profit, not the sales this time, but gross profit. That means it has already been done. Sales minus cost of sales has already been done. Gross profit 81,508. 81,508. That's the gross profit. Now less expenses. The various expenses that we have worked out. We have worked out electricity. I've taken note of it already. Electricity. Yes. So what happens is we have various workings. We have working, for example, workings number 1 for electricity. Electricity gave us 1764. After electricity, we worked out insurance. We worked out insurance and what? And rates. Yes, that was the very second working. That gave us 1260. $1,260,000. The next working after insurance would be depreciation. We have got 2 assets, motor vehicles. Then office equipment. Okay, the motor vehicles and office equipment. The amount of depreciation for motor vehicles. Motor vehicle amount of depreciation was 5820. Motor vehicles 5820. Then equipment comes in with 6696. Now take note that when it comes to depreciation, our concern is with the current year's amounts. We are not concerned with the previous accounting periods, but the current depreciation charge. Then we had director's fees next in the workings. Okay, this was working depreciation working number 3, director's fees. This was working number 4. Director's fees was 25 plus 5, that was 7.5. 7,500,000. After director's fees, we had other costs like debenture interest. We said audit fees, there's nothing to write there for workings. We have debenture interest. Okay, these two, debenture interest and preference dividend, are finance costs. So I would group them, I'll bundle them together this way. This is debenture interest. Is an example of finance cost. Preference dividend. There are two things, debenture interest and preference dividend. Now the debenture interest we worked out to 800 times 2, that is 1600. Because when you're recording an expense, you record the full, we're using the accrual principle. You record the full amount of that expense, regardless of how much or what portion was paid. Regardless of what portion was paid, the amount we record should be the expense for the whole year. It should cover the whole year across. Then for the preference dividend, we have taken 8% and got 3,200. Now you have to take care about how you report preference dividends. We have two types of preference shares. We have got redeemable preference shares and irredeemable preference shares. When the question does not specify whether it's redeemable or irredeemable shares, we take it this way, that these are redeemable preference shares. And when they are redeemable preference shares, we classify them as a loan. Yeah, as a long-term loan. That's why the dividends earned on those, payable on those shares are also treated here as an expense. Yes, so that's how we do that. The next expenses, we calculated preference dividends. After that, we don't calculate any other expense. Okay, so far we have this general director's fees, debenture interest. May have to go to bad debts. We have to go to bad debts. Okay, the amount of bad debts is 340. Yes, the amount of bad debts is 340. We have, after that, salaries and wages. The amount is 28,200. So 28,200, 28,400, 28,200. That's right. It's 28,200. Insurance and rates is there. Insurance. We have telephone expenses. The telephone expenses were 1216. We had telephone expenses 620. Telephone expenses. Electricity is already there. We have debenture interest, director's fees, general expenses after telephone. We have general expenses. That's fine. 1, 2, 3, 4, 5, 6. Yes. The burdens, insurance, electricity, debenture interest. Yes, we have everything there. 60, 60, 46. 5, 16, 40, 200. Okay. 100 and bonus. We have audit fees, not yet. Then 3108. We have audit fees. Yes, confirming is always a technique here, 1200. This is audit fees. So the next thing is summing up and again checking, confirming the totals of the expenses. 64 plus 1260. Yes, we have 61308. This represents the total expenditure or expenses. Therefore, should be deducted from the gross profit minus 81,508. We have 2200. And what is this? Okay, first of all, I want to tell you, examiners don't always give you the complete scenario. They don't always give you the complete scenario of a company, a typical case, which is complete, where they give you all the complete information. Sometimes you can't finish an exam. They select some items. For example, here they have selected and left out taxation. In another question, there'll be taxation to be deducted from this. Okay, so what you're saying is, if there was any taxation, it will be deducted from this. So whatever you're seeing here is, this is a profit before tax. Which tax? Corporation tax, or the one called income tax in accounting language. Legally we say corporation tax. That is, as a corporate, a body corporate, the company pays taxes out of its profit. So if the taxation was given, you will have to deduct it at this point. You'll have to make a deduction of that taxation at that level, at that point. Now, next will be, how do we prepare a statement of financial position? There is one working that you can only do after you have done the income statement. That working is about the retained earnings. So it's going to be working, I don't know what working number that would be. I'm not very sure. It could be working number 7. Retained earnings or retained profit. retained profits is the same thing as revenue reserve. Retained profit is the same thing as revenue reserves. So what happens? You are given a balance. I could just write in full. You are given in longer form, not full. You are given retained earnings at 1st of retained earnings at 1st January 2013 was 24,252. 24,252. This is the profit that was reserved from the previous periods, which was not shared out. Then profit or loss, that is the profit for the current year. The amount of profit for the current year, 20,200, is added here. You can now see the work of this account here is to accumulate together the profits. But at the same time, these profits have got various uses. Some of the uses, like let's say if there is any, if there was, get me, if there was ordinary, not preference, ordinary dividend paid. If there was. Now, you cannot do that in an examination, trying to educate the examiner what will happen. It's me who is doing it for the learner, that if there was any dividend paid, it will be entered here. But don't put a dash, anything with a dash there in the exam, just leave it. Then there is an amount which is transferred to general reserve. We were told at the end of the period, they will transfer 12 million to general reserve. Amount is big, so profit or loss. So general reserve, they will transfer 12 million from this total profit available. They will transfer 12 million to be added to the general reserve. And then of course, balance the account. So the balance, I beg your pardon, this is 44, the balance down here. Just the spacing, I beg your pardon. This is 44, 452. Now the balancing figure is the retained earnings. We are calculating the retained earnings as at the end of the period. That is 32,452. This is called retained profits, or you can also call it revenue reserve. It will appear under equity. I just trying to retain that figure, 32,452. Okay, that's fine. Okay, that's okay. So now the next is, how do we present a statement of financial position of a company? How to present a statement of financial position of a company. This is retained earnings. I need that space. The statement's a bit long. Make sure the title is complete, always. Okay, how do we start the statement? We start with the non-current assets. We start particularly with land and buildings. Okay, what we do is we combine the two assets, land and buildings. We had 100 plus 32, 200, so 132,200. The total is 132,200 for the land and buildings. Then we have motor vehicles. We have to try and follow our workings very closely. So motor vehicles. The net book value of the motor vehicles, I scribbled the answer on my question paper to be faster, is 980. I scribbled from the workings to retain that. Then we have office equipment. Okay, the office equipment, after deducting the accumulated depreciation brought forward of 17,200, and again, the depreciation for the current year, the office equipment gives us an amount of 2744. 2744. Yes, I noted it down. And the sum total now, you're supposed to display there to the examiner or the reader of the financial statement, the sum total of this group of assets, that is 132,200 plus 980, 2744. That is 153,924. When you come to current assets. Okay, the current assets, we have inventories. Apart from inventories, we have trade receivables. You see, at some point you have, yes, apart from just learning, it's just memorizable very fast. We have closing inventories given at 83,852. Some things now should be automatic in your mind. It should be part of the mind of an accountant, like how do you arrange assets in the statement of financial position? Okay, trade receivables, we have 27,200. Then what follows is either if there is any income receivable which has not been received, or there is any prepayment, we have prepaid insurance. Yes, we have the prepaid amount of prepaid insurance. We said 150,000. That's half of that amount was a prepayment. Then we had the bank balance or cash at bank. The amount of cash at bank or bank balance is 7796. 796. So what follows is that I'm trying to demonstrate how we go about it. We add this, and the total, the sum of the current assets should be added to the non-current assets. I'm saying that in case someone is looking at this for the first time. So we have the total of the current assets, 118,998. Yes, those are the steps. First, get the sum of the non-current, come to the current assets, then come to the full assets, total assets. You even put a label here, total assets. So putting titles and labels is very important in this kind of a question. So I'm adding the non-current assets. I don't want to assume anything. And getting the total 272, 922. 272, 922. What does this stand for? Total assets. Now, remember the accounting equation, assets equal capital plus liabilities. Capital here is the equity. Then we have the liabilities. So the title, the big title here would be equity and liabilities. It's a title here, equity and liabilities. The main title there, it will cover now shareholders' equity, non-current liabilities, and current liabilities. We start with the shareholders' equity. Now, in this question, as I stated, in this question, the equity comprises the ordinary share capital, the ordinary share capital is 120. As part of equity. Now to make the whole of the equity, we have general reserves. We said once the general reserves are added up, the previous plus the newly added, the general reserves will be 40 million. Yes. That is the general reserves we had at the beginning plus the amount transferred from retained earnings to general reserve. Then we come to revenue reserve. That's a retained profit. It's also called retained. Revenue reserve is also called retained earnings. That was 32,452. Very important as you do the workings, you keep also preserving those workings. Then you get the total equity. That is the amount of shareholders' equity. The amount of shareholders' equity. That is 192,452. Yes. After shareholders' equity, we come to non-current liabilities. Non-current liabilities. Yes, non-current liabilities. We have the following. We have any loans and preference shares. We have 10% debentures. The amount which is given on the 10% debentures, the principal sum that we borrowed, that was 16 million. The other one, this is continued. Yes, this is a continuation. We have the 8%. Long time, the preference shares were being shown under equity. Now the preference shares in the new standard, IS1 preference shares, 8% preference shares, the space, be forgiven for that. The 8% preference shares, the face value, the nominal value of the shares, we had 40 million. Sorry, 40 million. We are dealing with liabilities. We have other liabilities. So when we have others, I have to start from here. Then I come to the current liabilities. Okay, the current liabilities, as usual, we start with the accounts payable or trade payables. Put it on top, always. Yes, the amount of trade payables was 13,722. We have a whole lot of other liabilities here, which are accruals. So here we say accruals or accrued expenses. Then you list those accruals. One of the accruals is got to do with number one, not one, electricity. Accruals, electricity. Amount of electricity accrued is 548. We had next accrual about directors' fees and debenture interest. We had directors' fees, 5,000. Then after directors' fees, we had audit fees. We had audit fees of 1,200. Then debenture interest. The debenture interest, that was half of the total. That was 800. Yes, was that debenture interest. There is also the proposed preference dividend. Proposed preference dividend, not ordinary, no. Only the proposed preference dividend. Ordinary dividend is excluded, must be excluded because it's not liability. We call it contingent liability, which is different from liability. An amount which the company has an option, though they have declared it, they still have an option of dishonoring, of not making the payment. In the event the company has got shortage of funds, one of the things they will not pay, the first thing they will not pay is the ordinary dividend proposed. I'm trying to make sure that's readable. Yes, so the amount of proposed preference dividend was 3.2 million. So now what I do before I make the blunder, just adding figures, what I do is I make a confirmation of my figures before I do the final addition from the workings, that is. Then I sum up the liabilities to see whether, before I write them down, to see whether they agree with the assets. So the total liabilities, my total of the liabilities, okay, 480. Okay, summing up the liabilities, 13,722. So I get this 80 for 70. That's the total liabilities. Then I add to the total equity. Equity is 192,452. Then one gets 272,922. That gives one the confidence that things are right. So the total is 272. Uh, 922. That is the total of equity and what? The total of equity and the liabilities. Total equity plus liabilities is 272,922. So this itself demonstrates that it's quite possible for you to work out such a problem and balance it. Yes, pretty well. You can work out this kind of question and you balance it. Now, there are one or two things maybe I'll just want to explain about. So this is just further issues which are not directly concerned, which is not directly concerned with what? With this particular question. This is about share capital issues, and especially because they're important for cash flows. It's important to understand. Okay, so we have different types of issue. That is the different types of transaction. How the company gives the shares to shareholders. A, we have what we call a public sale, public offering of shares. Now, in this case, the company sells the shares to anybody who is ready to buy the price, and this normally this sale is at market value. Yeah, the sale is at market value. Let me say market price. Without, in other words, having to make any special concessions or consideration. So what happens here is when the shares are sold, we debit the cash account. We debit the cash account and credit the share capital account. We have what we call a rights issue. What happens in a rights issue? The company is selling shares, yes, but it's being very selective, discriminative. It sells the shares only to internally to the shareholders. So that means a sale selectively to existing shareholders. It's internal. This is an internal what? An internal offering or sale of shares. Now, usually, the purpose for doing this is they want to sell the shares there at a reduced price. They want to sell shares, the company will make cash, will get cash, but the amount will be reduced. The price is reduced. The other one is what we call a bonus issue. It's what we call a bonus share issue. Actually, the word bonus comes with the word free. Yeah, so yeah, I'm saying a bonus share issue. The shares, in the real sense, they are not being sold, they're just being issued. The company distributes new shares to shareholders without the shareholders making payment. So there is no cash inflow as far as a bonus issue is concerned, but there will be an increase in the share capital because the shareholders will be holding what? The shareholders will now be holding more shares. Yes, so this gives us a picture of how we prepare or present financial statements. Now, you may also take note. There are other good questions. Other good questions you may practice. Yes, you have other good questions you may practice and practice. The next lesson will be more concerned with where a company is involved in manufacturing. That is in lesson 2, a company that now has got some specialized activities like what? Like manufacturing. So that brings an end to our